The seasons of agriculture have many ups and downs. You want an ag lender who understands the challenges and decisions you face on a daily basis. At the Citizen State Bank, we offer financing options built around your operations needs, offer competitive rates and in-depth analysis, and high-quality customer service. From our operating lines of credit to cover day-to-day expenses, to our agricultural real estate loans to position your operation for a successful future, we have the tools for you. We pair our agriculture lending services with professional risk management products through Terra Financial Incorporated. At Terra Financial, we are focused on helping you find success in production agriculture. We understand the importance of providing quality and timely information to our customers and developing strong, lasting relationships built around knowledge and experience. For your banking, lending, and crop insurance needs, be sure to stop by one of our convenient locations. Visit us on the web at www.thecsb.com or give us a call today. Terra Financial Incorporated is an equal opportunity provider, and the Citizen State Bank is an equal housing lender. Member FDIC.
Good morning, everyone, and welcome to our mid-year ag webinar brought to you by the Citizen State Bank, Home State Bank, and Terra Financial Inc. Crop Insurance. Thank you all for joining us this morning. We know you have busy schedules. My name is Tyler Ottensmeyer, and I'm an ag loan officer here at the Citizen State Bank in Gossel, and I'm going to be your host for the day for the Citizen State Bank. I'm looking forward to our presenters today. And I believe we have our first presenter up and ready to go. That is Dr. Brian Briggeman with Kansas State University. He is going to be presenting on inflation and interest rates today. And I'll now let him talk about himself and his presentation.
Great, thanks, Tyler. Let me share my screen here. Oop, I think you need to, there we go. Okay. Well, good morning, everyone, and thank you for the opportunity to come and present during this mid-year ag webinar. As Tyler said, my name is Brian Briggeman. I'm a professor in the Department of Agricultural Economics, and also I am the director of the Arthur Capper Cooperative Center. So at K-State, I teach ag finance, and I also teach a cooperative management class. Conduct a lot of research in the area of finance, issues facing cooperatives, because through the Capper Center, I do a lot of research to help benefit farmer cooperatives, and also run a number of education programs for cooperative employees, farmer directors, co-op CEOs for here in Kansas, regionally, and also across the United States. But today here, we're not going to talk about co-ops, although if you have a few co-op questions, I probably could help try to answer them. Today, we're going to draw on some experiences I had when I worked at the Federal Reserve Bank of Kansas City. I was an economist there before I came to K-State. And Tyler asked me to come in and share a few thoughts that I have on interest rates and inflation. So after the webinar here, when I'm done, I'll send Tyler a PDF copy of my slides, and he can circulate that as he best sees fit. But again, please, as Tyler said, if you have questions as we go through, please feel free to type in those questions or comments, and I want to try to make as much of a dialogue as we can, even though we are together virtually. So whenever we start off of looking at the macro economy, we want to look at the overall broad economy, and then I'm going to narrow it down and look in at interest rates and inflation and give you my take, my perspective on how things are developing. Well, first of all, the good news is the economy is in a strong recovery. As we continue to get economic data in, Q1 GDP growth is quite robust at 6.4%. And as we look at various economist forecasts, I pulled down the Wall Street Journal forecast here. We expect continued strong growth of 8.2% in Q2, 6.9% in Q3, and then 5.1% in Q4. So that is a very sharp recovery from a very steep decline as we shut down the country during the COVID-19 pandemic. And so the reopening of the economy is going pretty well. And we're seeing that come through in terms of GDP growth. So the way that we measure the growth of the value of goods and services and products produced within the United States. And as we look at these increasing data, one I'll probably draw attention to first is on consumption. We as a nation, about 70% of our total GDP is tied to consumption. We are a nation of consumers. And so as we see consumption, when it fell off during the pandemic, that's what caused the recession. And now we're starting to see it come up. And also what I noted, that imports were up 876 billion. And for us in the US and as a global economy, that is a good thing. We can start getting global trade routes, supply chains back to hopefully functioning more normal than when we shut them down. And of course, us in agriculture, trade is very important for many of the products that we produce and sell, not only here within the United States, but also across the globe. Another thing that we've noticed through this pandemic, or coming out of the pandemic, is home prices are up very sharply. In fact, for the first time ever, the median home price in the United States eclipsed $350,000. I know, speaking from Manhattan, Kansas, talking to some of my real estate friends, we are at very low inventory levels. Homes hit the market and they sell very, very quickly. And we're even starting to see in Manhattan some commercial investors starting to come back there. So it would appear from a real estate standpoint, that's a positive thing, starting to see recovery there. The question is it inflated? I know many of us have fresh in our minds the financial crisis of 2008, which was caused by a home crash, home prices collapsing. We had very low interest rates at that time, and home prices were pushing up. So again, we have very low interest rates. Is this home price, is it stable, or how is it being handled? Yet to be determined, and we'll see, but what we're seeing right now is strong home price appreciation. Also, we're seeing manufacturing is improving. We're seeing plants start back up. The ISM index, which Institute of Supply Management Index, looks very closely in surveys on expansion and production, and we're seeing that index is rising where many manufacturing is going, and that is a good thing. Again, producing goods, employment opportunities as well. But we're also seeing inflation has come back up, and we'll spend more time talking about that. But the personal consumption expenditures index sets at about 4%. And if we were to look at the CPI, a consumer price index, that's about at 5.5%. So certainly higher than what we have experienced in the past, and it has raised some concerns for some folks. We'll talk more about that later. The other thing that I always look at when I'm considering the overall economy is like, okay, well, let's look at the data, look at consumption, see where those things are that drive GDP growth, but also how is the labor market evolving, improving? And certainly it took a big hit during the pandemic in 2020. But right now, as we're looking at it with the most recent data that came in with the June labor reports, it is improving, and we're starting to see it gain some momentum. So the unemployment rate sits at 5.9%. Way down from where it spiked up to nearly 15% back in 2020. The other thing that is a positive is we have seen those unemployment insurance continued claims. So those individuals that go in and continue to claim for unemployment insurance are down sharply. It hit a high last year of about 25 million, and right now sets just below 3.5 million. So there's still certainly, I still hear reports of challenges trying to get folks incentivized to work when they can collect that unemployment insurance check. But we are starting to see some real positive signs that I hope that reason for people not working will go away. And the way that I want it to go away is that there's an incentive for them to go work. And we are seeing employment and wages are starting to rise, especially in the service industry. As we see the service sector, as we're beginning to reopen and people are more comfortable traveling and going out to eat, we're seeing some wage increase for that service sector. So that is a positive point. But we're not at pre-pandemic levels. If you look back to January 2020, we're still 6.5 million jobs under that mark where we were at that time. But I question, is that the level we will return back to? One of the things that we have learned through this shutdown and remote work is businesses start figuring out very quickly, well, what is the job that we need to keep and what job maybe can go away or maybe could be reduced down to half time. So yes, we're not at those pre-pandemic level number of jobs, but maybe there are some efficiencies that have been gained in there to where we won't actually return back to that level. And then finally, looking at interest rates, just real quick, forecast from what reading, I really feel that we're going to remain low for a while. I know the Fed has come back and changed their tone about raising shorter term rates now by 2023, maybe a little bit sooner than expected, and that might happen. But as we look at some of the data that's coming through, this lower period of lower interest rates appears to have set in here and it's been going on for quite some time. Hopefully we would start to see some of those longer term rates begin to rise because that's an indication of the economy is starting to recover and begin to grow. So hopefully by the end of 2021, we'll begin to see those longer term rates really begin to pick up. So on that interest rate note, one of the things to look ahead is we can look at the near term prospects, which would appear that here for 2021, 2022, lower term rates will remain low. But as we look out ahead, longer term, 3+ years out, what does the interest rate outlook look for that? And what I always like to do is just turn directly to the authority that controls short-term rates and really has some control over long-term rates too. And that's the Federal Open Market Committee, or the FOMC. The FOMC is the voting body of the Federal Reserve that sets that short-term interest rate, the Fed funds rate, or the rate that banks lend with each other. And starting back in 2012, in a push to be more transparent, the Fed began, the FOMC members began reporting what their outlook is for interest rates. And what I did here was I calculated that midpoint longer term interest rate projection. So every Fed committee member has a vote, and they are in this projection, and they say, this is where I think long-term rates are going to be 3 years out from the date that they set it. So if we look back in 2012, at the very start of this graph, the midpoint longer-term short-term rate was right around 4%. And then calculating it each year as they release these projections, that midpoint, you can see that steady decline over time. And in fact, that 4% back then, this was right around at just after I left working at the Fed. And when I was at the Fed, 4% was kind of the gold standard. It seemed that everybody said the economy functions best, market signals are clearest when we have a longer term short run rate of 4% is our target. But as this coming off of the Great Recession and then the COVID-19 pandemic shutdown, there appears to be a new view that is starting to settle in, where we are looking at a more 2.5% short-term rate. So nearly cutting in half what we were before, when we maybe had a bit more normal, maybe quote unquote normal expectations from the past. Whereas today, with the way things have evolved with monetary policy, with fiscal policy, with global trade patterns, where we're at, it would appear the Fed would be saying that 2.5% is maybe where we are settling in at for the longer term. So as I look at it, that's where my projection of looking at lower rates in the future is coming straight from the body that sets these rates, and they're telling it through to us through these projections. The other thing also that's relevant and has an impact for us in agriculture, because I don't want to just spend all my time on the macro economy, but what does it mean to us? Generally, we see some relation with the value of the US dollar and how these interest rates are set and how things move. But what we have seen here recently is what I would deem as a flight to safety. So here in this graph, I show the US dollar index. So it's indexed to 2006 based on a broad basket of goods and services. And what we see during times of stress, like what we had in that gray shaded area of the 2008 financial crisis, a flight to safety. So demand for us, even though we're sending interest rates down at the time, people were flocking to buy our US treasuries because we were the safest of the bunch, right? So pushing up the value of our dollar. And we saw the same thing happen when the COVID-19 pandemic spread across the globe. People flocked to us. You see that big spike up in the value of the US dollar, which for us in agriculture is not a very good thing. It makes the prices of our goods and services, prices of our products, commodities that we're selling in the global marketplace more expensive relative to our competitors across the globe. So that is initially is a pain, but what we have seen since that time, the value of the dollar has fallen. Some were very worried that it might continue to decline because of all of the fiscal stimulus that's being pumped into the economy, all of the quantitative easing. Could we just be devaluing our dollar? But what we've seen is it's starting to level off a little bit, at least appeared within the data, maybe around just below those pre-pandemic levels. So that it appears the US dollar is beginning to kind of level off where that's at, which is pretty remarkable when we start to look at some of the debt figures that we have within the US. But just looking at that US dollar appears to be leveling off. Now, longer term rates, for many of you, hopefully you had these conversations, especially mid-year 2020 and then towards the end of the year 2020, fixed rate financing was extremely attractive. And by and large, it's still attractive today. But in 2020 was when we saw those longer term rates really fall in a way to maybe term out some possible debt that we had accrued, or to maybe make a purchase, seize on an opportunity for a capital investment into our agribusiness, our farming operations, livestock operations. We had that attractive fixed rate financing. Now they're still low, but they're not quite where they were maybe at the end of 2020. But this brings up another point of when we think about financing our operations. Yes, we need to look at that fixed rate, but also don't forget about the variable rate financing products that might be available. And the reason I bring this up is maybe it's not happening right now, but we might be entering into a period when you weigh that variable rate financing versus fixed rate financing. The variable rate is more attractive because the spread between the variable rate and that long-term rate is wide enough that we can have maybe some sizable interest cost savings by using a variable rate product. So here, rewind a little bit to kind of build up that argument with the data that I'm looking at that might send a signal that we might be moving into that period. So from 2010 to 2016, many conversations that I had with cooperatives, with private agribusinesses, multinationals, even farming operations and livestock operations, during that time, many people were utilizing variable rate financing products because it was a protracted period from 2010 to 2016 where there were significant cost savings because that variable rate interest rate was so much lower than the longer term fixed rate. And if we look at this spread, so looking at that 10-year treasury, so the longer term rate minus that 2-year treasury, the shorter term rate, you can see here between these red bars from 2010 to 2016, there were periods where that spread was elevated for a long period of time. And if we look back in history, it remained that way. Typically what happens is we have that begin to narrow up, and then something happens within the economy where short-term rates go above long-term rates, we enter into a recession, and then it begins to switch back. But this low interest rate environment that we are in, at the Federal Open Market Committee, that has signaled to us that we plan to stay in makes this opportunity for variable rate financing where we have to give it some consideration. So we look at that period of 2010 to 2016, that's what all the talk really revolved around. But then, as you can see, it fell off, it got very low, near to zero, and then we entered into the pandemic. And we saw like longer term interest rates were very attractive. Really, variable rate didn't make much sense. But as the economy begins to recover, as if the Fed continues to leave that short term rates lower, we're starting to see that spread begin to rise. And could that continue, especially if the economy really recovers and starts to continue on and we keep those short term rates low? I would be paying attention to that if I was, in an agribusiness or a farming operation or livestock operation. Monitor those variable rates. That would be it's probably not there yet, but if we look back at what happened in 10 to 16, that could possibly return. It would be something I'd be monitoring closely. Now, of course, with these low interest rates, you have to think about the debt levels that are there, because if we raise those interest rates, well, all of a sudden this public debt that we have out there as a nation, as an economy, might become unmanageable because of cash flow and budgetary issues. So I pulled to look at the federal debt that's held by the public. I pulled this figure from the Congressional Budget Office report. You can go there and read it to have a understanding of the broader picture that they talk about. But I want to talk about this snippet here of looking at the federal debt held by the public divided by gross domestic product. Right. So think of this almost like, well, how much debt can we afford? Right. So the debt to GDP ratio. And you can see through times when we had World War I, that ratio rise, Great Depression, that rose with other programs and GDP collapsing. Then World War II, where it eclipsed 100%. So we had more debt than our GDP as we were funding the wartime effort. Even the Great Recession, and now we hit the pandemic, where we were in a war with the virus. I've heard some people describe it as. We're back to that 100% mark, right? That we've reached up to that, and as we look going forward, programs like Medicare, Medicaid, Social Security, other programs, the CBO is projecting that it could rise to 200% in 2050. Clearly not sustainable. So at some point that has to go under control. But I think there's an important element in here of considering, well, why do we have it so high right now? And it would appear, as we're discussing a potential stimulus bill, an infrastructure bill, why would we want to continue to add? Well, part of the story in here is the interest rate environment that we're in. Much like back in World War II, if we were to take interest rates at that time and then look at federal interest paid on that debt as a percent of GDP. So here I took federal interest expense divided by GDP to look at, well, how much of interest is being paid. Back World War II, it was just 1.8%. Today, it sets at about 1.5%. So we have, yes, it's sizable debt, but in a way it's manageable given the interest that is being paid on it. And I also bring this up because if we look back at that 3.2%, which is, basically double where we're at that time. So that occurred in 1995, back when the last time we had a balanced budget, where actually we had a budget surplus that was happening. And I bring that up because at the time, President Clinton was in office, and his Economic Council of Advisors, the chair of that was Janet Yellen. So Janet Yellen today is the current Treasury Secretary. But back at that time, if you go back and look at a lot of the reports that she put out from the Council of Economic Advisors, and then also to President Clinton at the time, was our debt levels are too high, interest expense is too high, we need to control our budget. So if we look at where we're at today with that 1.5%, if that begins to edge up, right, where we begin to see those interest expense, if history holds, I would hope Treasury Secretary Yellen would begin to say, we need to manage this, we need to get this under control. And certainly as we look projected out to 2050, those conversations need to be happening right now. But when we look at those being added on, this low interest rate environment has made that debt appealing. But again, looking forward, it's something that we need to handle and control going forward. So with all of that, certainly top of mind when you think about low interest rates, very high debt, an economy that's recovering out of a pandemic, and we go to the gas pump and we pump gas and we're seeing nearly $3 a gallon gas. What about inflation, right? So where's the inflation in this story? And without question, prices of goods and services have risen sharply. Here I have the personal consumption expenditure index. This is the preferred inflation measure that the Fed looks at. If I put CPI in here, it would be about a little bit higher, around that 5.5%. But no matter what inflation measure you use, we definitely have snapped up. You can see the rise in this graph on the far right where it's gone up. Now, a lot of this is just transitory, and the Fed has come out and has made these claims, and I agree with them. I share the same opinion that these inflationary pressures that we're seeing now is more returning to back where we were before the pandemic. As we begin to fix supply chains and things begin to reopen, it's not surprising in the case of gasoline, where it fell down to nearly $1.50 a gallon, that we're returning back to where it was before the pandemic, because this recession was so different, where we shut it down and then we're reopening it. Many of these inflation pressures are likely transitory and will subside at some point. But with that being my opinion and how I'm evaluating things, certainly there's a possibility that inflation could continue, but it's not very likely at this time, just given some of the ways that it's helped to push that up. Now, the other thing, look at the Fed and kind of my opinion of looking at inflation. Sorry about that. Looking at inflation, we would look at the market's opinion of inflation and where it is going from how the market perceives inflation, where it's going, because the market plays a big role, especially if we were to have inflation take off and not be transitory. So we need to look at where the market is at. And if we look at the 10-year break-even inflation rate, so this is the 10-year outlook for the market for inflation, we can see that on the left-hand side, where it dropped very low during the recession, the Great Recession of 2008, 2009, where it fell to near 0%, where the market was expecting maybe even possibly deflation, but we didn't quite hit there in the 10-year mark. We can see a similar collapse in the pandemic, where it fell, but as we began to reopen and things began to come back to normal, we saw that creep up and to just under 2.5%. And in fact, if we look today, we're even beginning to see that come off a little bit. So at least from the market perception for the 10-year rate, and even if you look at the 5-year rate, it's just a little bit higher than that. We're beginning to see that begin to flatten off and not continue to rise rapidly, to be more in line with what we've seen historically. However, the other thing to look at within the Fed, within the market, are TIPS rates, or Treasury Inflation Index security rates. So these are rates that are tied to inflation. They are a hedge against rapid future inflation. And what we have seen at this time today, if you look on the far right-hand side, negative rates for these 10-year TIPS. And so what that means is that investors are willing to pay a premium to have their principal protected in these 10-year TIPS. That's what a negative rate means. So it could be, we saw it happen once before in 2012. We see it now again. The fear of future inflation is one motivation for that. It's also just a motivation of, I'm looking at all of these different assets that are out there, and I'm willing to pay a premium to protect my principal going up. A lot of pension funds, for example, or long-term benefit industries and companies are looking at this because they want to protect that principal for them, and they're willing to pay a premium for it. But that would be a signal that, people are hedging against maybe things are not transitory and maybe things would tend to take off. So future inflation, these headwinds, I think, are pretty significant, weighing down, that prospects of like how we would think about really rapid inflation, like what happened in the 1970s and 80s. That concern of core inflation is just not really there. Like the Fed isn't worried about when we strip out very volatile things like energy and food and commodities. There's also over all industries very low real wage growth. We just really haven't seen that wage growth appreciation that tends to go with those rapid periods of inflation. We just haven't seen it. Now we're starting to maybe see some signs in the service industry, but it's not broad, like across with manufacturing, for example. Also, we're a globalized economy now. We're connected across a global supply chain, and as that begins to ramp up, that also too is a pretty significant headwind for inflation. Also, the market has very well anchored inflation expectations. And right now, the Fed is out putting a very low probability on it. So all of those items are pretty significant headwinds of future inflation. Now, there are signals for possible, right, of future inflation. We're in a strong economic recovery. There's very high US government public debt and very large budget deficits that if they persist, and we see that Congressional Budget Office really does come to fruition where we have that 200%, that would be a signal that we're going to have that future inflation. Prices and goods and services have certainly elevated, but will they remain there? Are they truly transitory? They might not be. That would be a signal. Potential dangers of protectionism trade policies. If we move away from that globalization economy, that could lead to that future inflation, and of course the negative tips rates that I showed before. So in conclusion, just some comments and kind of takeaways. The US economy is improving. Key to continued recovery is that consumer confidence in the COVID-19 vaccine. As we have that go across the US and consumer confidence begins to build back up and people are more comfortable going out, and I'm talking across the entire United States, we could see that go up. I would project that low interest rate environment will likely continue for 2+ years. And I would start to pay attention to those variable rate interest rates for the argument that I made earlier and for our recent history showing that those products might be more appealing as that spread widens between short and longer term. Could rapid inflation arise like it did in the 70s and 80s? I'd put a very low probability on it. I wouldn't say it's zero, but it'd be more of hopefully we would have the tools and ability to avoid that, and looking at that return to demand for products. And then for you all running your operations, I think this is a time where, put big emphasis on building liquidity. Look at that balance sheet. How can you find ways to build up that working capital, improve that liquidity position, use debt, but use it in a manageable and smart way. And don't be afraid of looking for those opportunities. I know I always have this as a last bullet on any slide, whether I'm talking to a co-op or a rancher. It all really revolves around that balance sheet. Make it as strong as you possibly can, whether in good times or bad.
Thank you for the great presentation. Next up, we're going to have a carbon credit marketplace and climate change effects on agriculture. Leading that presentation is Dr. Bruce McCarl from Texas A&M University. Dr. McCarl, why don't you tell us about yourself, and then I will let you move on into your presentation.
Good morning. Do you hear me?
Yes, we can.
Okay. I'm a distinguished professor of agricultural economics at Texas A&M. I've been doing climate change stuff seemingly forever. I think the first thing I did was in the early 1980s. At that time, I was pretty much a climate change skeptic, saying, what the heck are you talking about? But have become a little bit more convinced over time. What I want to talk about today is some of the background. By the way, can I share screen? I should start that. What I want to talk about today is some of the things that are seemingly going on in Washington and some of the obstacles that may occur in terms of getting those things implemented, as well as a little bit about why we might address the climate change question and why agriculture might be a part of that. So do people have any, you have any questions or comments before I get this started? I assume
not
my
seeing it.
screen is visible.
Yes.
I have to get rid of all the pictures somehow. There we go. So when I do a climate change talk, I usually start looking at it from this perspective, which is that we have a slow moving set of climate change events we've been observing. We have some issues in terms of reducing greenhouse gas incidence or limiting the future extent of climate change. Excuse me, my power fell out. And then we have some shorter term actions that we can do in terms of adaptation to climate change. And energy is another big factor here, in that about 80% of our emissions as a country come from energy. So today I'm going to basically concentrate over here on the mitigation side, but as agriculture, all four of these forces are going to influence what goes on in the future. So I realized yesterday I didn't put in a plan of talk or much of a conclusion slide, but we'll just wing through it. Climate change is definitely occurring, and it is expensive. In the 2014 Intergovernmental Climate Change report on Intergovernmental Panel on Climate Change report, the main message was climate change is not something we're going to see in the future. Climate change is something we're seeing now and will continue into the future. And here's just a little bit of data relative to that. This is the progression of temperatures over time. This starts back in 1880 and goes up through 2020. This is annual data. You can notice in here, it's been 44 years in a row since we've seen temperatures below the average in the last century. 2020 was the second warmest year we've ever seen. It was just slightly below, I think that was 2017 or 18. The 7 warmest years we've ever seen have all occurred since 2014. The 10 warmest years we've all seen are since 2005. And when I say what we have seen, that refers to the instrumental record since 1880. We don't have instrumental data before that, for example, back thousands of years, because cavemen and dinosaurs didn't learn to put up instruments. Okay, we also see a lot of things happening. There's a lot of evidence that agriculture in various places is being disrupted, with effect on pests and water supplies and irrigation water requirements and hotter conditions and more yield variability, and in places decreasing yields, although there are also places where the warmer conditions have increased agricultural production. One sort of striking piece of data is this data from NOAA on billion-dollar disasters. And you can see here that as of 2020, we had $22 billion disasters, whereas back here in the late 60s and 70s, we'd have 7 or 8 per year. We've had a pretty big climb in this. There are a number of different categories of these disasters. This one here is tropical cyclone effects. This green one is severe storms, and then we've got fires. Right now I'm in Colorado, and last year in Colorado, within 100 miles of where I live, we had the 3 biggest fires Colorado had seen in the recorded time period. So many people are saying, given all of this, urgent action is needed on climate change. Now, the scientific community basically has established a consensus that greenhouse gases are the cause of this climate change. This one yellowish picture gives a relationship between carbon dioxide concentrations and climate. And notice it's climbed up, I think 416 parts per million is the current observation on atmospheric carbon dioxide concentration. When I started this work, we were down here at around 335 or so. People tell me that as of a few years ago, the amount of carbon dioxide that we put in the atmosphere, if we liquefied it, would more than fill the Gulf of Mexico. Carbon dioxide, though, is not the only part of the story. Methane, nitrous oxide, and some industrial gases are also contributing to climate change. And if you consider those, we're at about 400 parts per million in carbon dioxide equivalent, but we're well over 500 or so by the time that you include those other gases. So the desire then is to manage atmospheric concentration of these gases. Now, agriculture is a major player in the amount of atmospheric greenhouse gases. In the US, the estimate out of the US Global Climate Change Research Program, or out of EPA, sorry, is about 10% of the emissions. Globally, agriculture is close to 25% of the emissions. The reason for the big difference between the agricultural share in the US and globally is tropical deforestation, which just about doubles it. So globally, the agricultural share is more like 10 or 12%, and then the deforestation part comes in to double that. And most, or a lot of that land that's deforested is deforested for agriculture. So again, it's an agricultural issue. Historically, agriculture is responsible for about 25% of the increase in carbon dioxide in the atmosphere. As of roughly the year 2000, we've put quite a bit more up since then. Notice land clearing is a pretty dominant factor up until like 1950 or something like that. But then fossil fuels has taken off and is the bigger factor today. So the issue then that this reveals is, are the ways that we could reverse some of the effects of that land clearing to store more carbon in the soils. And that's what the big issue is in Washington today. With the US rejoining the Paris Agreement, ag is becoming more prominently mentioned. Farmers are a big part of this. Ag has the potential to absorb greenhouse gases by storing more in the carbon. In the soil, there's an annual carbon cycle where if you look at the carbon diagram over time, it very much looks like a sawtooth, because in the early spring, as things grow in the Northern Hemisphere, they take up carbon. In the fall, when they drop leaves and plants are harvested, they release carbon. There's a very big annual carbon cycle with fluxes back and forth to the atmosphere. And the plan is to retain more of that in the ecosystem rather than release it. The Senate approved the Growing Climate Solutions Act, that is supposed to help farmers profit from climate action. And it asks USDA to create a certification program to help people sell carbon credits. A lot of this focus is on the carbon bank, not as much so far has been on other alternatives. Agriculture in terms of greenhouse gas emissions can play one of four roles. Reducing emissions through fossil fuel use from tractors and grain drying and transport of commodities, coupled with nitrogen usage for fertilization and methane emissions from cattle, rice, hogs, manure management, etc. Emissions can be reduced. Also, agriculture can hold carbon in soils or plants. Agriculture can raise commodities which substitute for emission-intensive commodities. Biofuels is the most commonly mentioned one, but agricultural goods could be used in construction, replacing steel and concrete. So agriculture could offset by producing these substitute goods. And then if none of those are done, it's likely fuel prices will go up because 80% of the emissions are out of the energy sector. And so if one charges the carbon against the usage of coal or diesel or gasoline or other fossil fuel forms, then that could affect agriculture. Generally, society is searching for low-cost emissions. The first place they're going to look is in agriculture, in energy, where 80% of the emissions come from. Ag and forestry will only be targets if they're cheap or otherwise attractive to do those things. This is a little diagram or a little table showing what agriculture could do. Here, this is the effects on releases of carbon dioxide. This is releases of methane. This is releases of nitrous oxide. And you can see, for example, if you alter fertilization, you would change carbon dioxide emissions, you would change sequestration, you would also change nitrous oxide emissions. And there's a lot of different possibilities down here. The bioenergy changes all three of the gases. There are a number of things that could be done with livestock that affects methane. Looks like I have a couple of mistakes here and that some of these should be over in methane. I redid this yesterday and it messed up my alignment. And then there's some forestry actions, either afforestation or managing existing land or stopping cutting down trees. Now, this is more of a global perspective. This deforestation option is not a real big option in the United States, nor is afforestation to a great extent. Now, in terms of changing sequestration in agriculture, we can better manage our residues. The general saying about soils holding carbon is that soils are going to hold carbon when the addition of carbon to the soil is greater than the rate of decomposition of that carbon in the soil. And if you add more residues to the soil, you're adding more carbon. Less intense tillage would do that, cover crops, switches to deep-rooted perennials, conversions to grassland, increasing carbon input to the soil through fertilization, irrigation, and additional yields. Although there you have to be careful with what happens on the other gases, because while applying more fertilizer increases the carbon in the soil, it also increases nitrous oxide emissions, and it's a much more potent greenhouse gas. So it turns out in terms of its overall climate effects, it's not beneficial. And then on the forest side, we can plant more trees, manage existing forests to increase yields, fertilization, and things like that, promote growth, and use longer rotations. So despite all those possibilities, despite the fact we're concerned about climate change, despite the fact that one way of addressing it is to manage greenhouse gases, and despite agriculture having a role in this, people are saying things like, The number of acres currently engaged in these programs on a global scale is minuscule. I started looking at this stuff in, I think, 1998 or so. I was fairly optimistic then, but basically throughout the world, the programs that really meaningfully engaged agriculture in this are pretty small. The participation is pretty small. These are from a set of newspaper articles, which I referenced earlier, but they also said there are numerous technical changes to scaling this up, and that Biden's goal of doing this is running into the reality of how complicated and costly it will be. So there are a number of concerns that I want to review with you today. And here they are. I won't read them at this stage because I'm going to go through them one page at a time in the next few pages. So the first issue is, what about how much sequestration do we see on agricultural soils, and does it continue forever? Now, these are two pictures from science papers. This picture here shows over a number of years, from year 0 to year 25, how much carbon was accumulated in soils when tillage was changed. And the striking thing to see here is there's a pretty wide variation in this. This is across 253 tillage experiments. I don't see 253 dots here, but anyhow, it's representative of the results of those 253 experiments. And one striking feature is it varies a lot. This is kind of the average. And the other thing that you'll see is that after a while, the gain falls basically to 0. What happens when you add more carbon to the soil is the microbes in the soil that decompose carbon start to accumulate. And eventually you get to the point that the increased carbon decomposition equals the increased carbon addition, and the soil hits an equilibrium. It's a little bit like pouring water into a cup. You do a great job of accumulating water in the cup until you reach the top of the cup, and then the rest of the water runs over the sides. So one thing you might notice is here after 10 to 15 years, the amount of increments basically approaches 0. And same thing happens on the forestry side. It takes longer. After about 80 years, it reaches some sort of a new equilibrium, and the amount of carbon that you can add saturates. The second thing that's important to talk about is volatility. If we use no-till and we put a bunch of carbon in the soil, but then there's a big weed infestation and somebody goes out with a moldboard plow and turns the field over, that carbon is exposed to oxygen and oxidizes, and it's no longer stored. So the carbon is in a volatile form. If it's in trees, or if it's in standing perennials, or if it's in the soil, there are circumstances where that can be reversed: fires or erosion, or going back to more intense tillage. This is different from many forms of greenhouse gas control. If you have a manure lagoon and you put a tent over it and you capture the methane that's coming off the manure and you run that through a generator that burns it and makes electricity, that methane can never come back. It's permanently destroyed. So in one case, it's a permanent removal from the system. In the other case, it's conceivably temporary storage. That sequestered carbon can be released. So what this means is if somebody's been using no-till for 30 years, they may have already saturated, but if they change their practice, then they're going to release it. So the question is, do we not only maybe need to pay to store some carbon, but do we need to pay to maintain that carbon. Also, I will note that this carbon, since it's in temporary storage, is worth less than greenhouse gases that are permanently destroyed. So you're likely to see a lower price. There also is a lack of one-size-fits-all solutions. Many people have said no-till gains, but when you look across all the studies, the gain isn't true everywhere. The results are lower for soils in cool and warm, temperate, dry climates, and for loamy, silty, and clay soils in tropical dry climates. To me, being from Texas, this warm, temperate, dry climate, carbon sequestration's not so hot there. So we can't conclude that soils are going to do better on a uniform basis. It's only in select cases, and those need to be identified. The next issue is the additionality issue. When the Kyoto Protocol was designed in 1998 or so for a global carbon agreement, which was the predecessor to the Paris Agreement, people were really concerned about something called additionality. Namely, they wanted to pay people money to do things that would cause more carbon to be sequestered. I was at an international meeting one time and somebody came up to me and said, we need to be paying the people in India for their cemeteries. And I said, oh, why? And they said, well, there's trees in there and they're storing a lot of carbon and they're growing some. And so we should pay for that. Well, those trees were planted 100 years ago and there's no intention to plant anymore. So if we pay money to those cemeteries, we're not going to get any more carbon. Nobody's going to go cut the trees down. The trees will keep growing. It's really an income distribution issue. Do we want to reward those people for things that they did in the past that are keeping some carbon out of the air? Or do we want to say, since that carbon's going to keep accumulating anyhow, it doesn't make sense to spend scarce money on it? You can notice there's a pretty big variance here in what's going on. And again, we kind of run out after 15 or 20 years. So out here, we'd be paying for maintenance, not as much for growth. But if we only pay for maintenance, then people may go in and plow their fields up and say, look, and hold out a year or two and then say, now I'm willing to adopt this practice, please pay me. So the question is, do we pay to maintain the current stocks or not? In a lot of the programs around the world, they have what they call an additionality test. Namely, they want to make sure the practice is not going to be used unless you pay for it. But they didn't in Alberta, and 95% of the people who signed up had been using that practice for extended time. So there weren't great benefits in terms of newly accumulated carbon, although there may have been benefits in maintained carbon. Another issue, which a farmer from Alberta or Saskatchewan taught me about one time, is when carbon trades and a farmer sells carbon, the question is, how long does the obligation last? Since that carbon is volatile, it can be lost. So if a practice is reversed, the carbon can be lost. The practices then need to be continued to keep that carbon in there, but they may be critically dependent on, say, weed control. With Roundup resistance, the issue is, can those weeds be knocked back, or do you need to go in with more intense tillage now and then? If you do, that's going to release some of that carbon. So you cannot reverse some of those practices and then fires, insects, floods, etc. Also, the question is, who does a sale bind? If you sell carbon to somebody on a permanent basis, does that mean that your heirs need to maintain those practices? Does that mean you need to maintain those practices 30, 40, 50 years in the future? Does it also prohibit you, from example, for clearing a woodlot or taking a field corner that's in grass and converting it over into carbon or into agricultural soils. In general, the less the soil is disturbed, the more carbon it holds. So if you're in trees and forests, you're going to have it more. And this really raises the issue. Most farm groups want to lease their carbon rather than sell it. So they want to obligate themselves to use that practice for the next 10 years, but not guarantee thereafter. Again, that should reduce the price because in one case, you're getting a permanent carbon offset as a power plant, for example. In the other case, you're going to lose that offset after some time. So you'd be willing to pay less for that. How do we handle uncertainty? I think I'm starting to run long. I can't really see the clock, but I'll go a little faster through this. Agriculture has pervasive yield uncertainty. You know, your yields vary from year to year. The yields are a function of plant growth, so is carbon. So the amount of carbon added to the soil is going to vary from year to year. And if you're a power plant and you want to buy some carbon offsets, then you want to know how much can I confidently count on. The Canadian government during the Kyoto Protocol said, we're not going to pay for the average amount of carbon you store. We want to pay for a discounted amount. And in sulfur dioxide trading, if you got caught short with your not meeting your obligations, you had to pay 3 to 5 times the market price. That means that purchasers don't want to buy on average for carbon. They want to buy amount that they're 90% or so sure they'll get that much or more. Now, this may imply we need to square up that they pay you a discounted amount, and then after a while you go in and see how much carbon you really are storing, and you square up based on that. But again, because of the volatility, this is kind of a difficult issue. I did some work one time on uncertainty in carbon, and the carbon accumulation under sorghum in a single county had about a 20% variation in yields, carbon yields. If we got to the state of Texas level, we were able to cut that variation in half. If we got to the US level, we again cut it some. If instead of taking a 1-year average, we took a 5-year average, then notice with this broad state of Texas portfolio, we had 1/7 the risk that we had up here. Well, what that means is that the carbon contracts, when they're sold, should probably not be a deal from one farmer to the buyer, but from a consortium of farmers that's widely spread geographically that says we're going to accumulate over a longer period of time, because that reduces the risk to the buyer. Finally, I have a couple more points. Measurement and monitoring being one. People kind of glibly say, well, we can go out and measure the carbon relatively cheaply. Well, carbon's everywhere. I'm looking at a 14,000-foot mountain peak from where I'm sitting, and there's carbon up there. Who's going to go up there and measure that whole mountain peak? We cannot truly measure. We cannot fully monitor. We cannot verify. This has stopped soil carbon in its tracks in a lot of places around the world. The sampling must be repeated. We need some kind of mix of modeling, sampling, and aerial measurement. Probably would get a decent estimate of what's there. In most of this, we may not pay by volume of carbon. We may pay by practice. When the Chicago Climate Exchange still existed, it had a differential rate for different regions of the country. I think it was an east-west split, but it may have to be a north-south, east-west split, or it may have to be a soil type split. Transactions costs is another important issue. On the Chicago Climate Exchange, when you were selling carbon, you had to sell a minimum lot of 10,000 tons. The average for an acre of farmland from a tillage change is about 1/4 of a ton. So what that would mean is somewhere around 11,000 acres, the quarter of a ton was carbon dioxide would be 0.84 tons. So you need about 11,600 acres with 444 acres per farm. That means 27 farmers would need to band together to sell their entire acreage. In other trading platforms, it's like 100,000 tons. This would be 270 farmers. In general, it's going to be larger groups. And if you talk about international development situations, then where the average farm size is more like 4 acres, you can see it's a big number. Brokers are going to be needed for crop insurance. The brokers take about 25% of the money they collect. For a house, it's about 7%. If this is a pure government payment, then the transactions cost can be pretty high. Under the farm program, people estimated it cost about 50% more than the money that they gave out. Okay. Finally, there's a reluctance to use carbon sequestration. Somebody at Greenpeace said that offsetting is a way of paying others to reduce emissions or absorb, but the way out of the climate emergency is not that simple. They say offsets don't reduce emissions, so it allows emitters to continue with this unsustainable behavior, and we just shouldn't do it. So there is a faction out there that says carbon sequestration is a bad idea. We need only to work on the emission side. So something happened on my screen and I can't see the top. Hold on. Let me just make a couple other points and then I'll quit. We do need to identify this differential greenhouse gas reduction by region. There's a lot of arguments in ag that yes, not only do you get carbon, but you get increased yields and better water quality and things like that. However, that doesn't entirely carry water, because if you cut back on a coal-fired power plant and you reduce their emissions, then you get cleaner air, less of a pollution load. And sorry, I'm in my house and my wife is cooking something. I don't know if you'll hear a crackle. But anyhow, you get co-benefits not only from agriculture, but also from non-agricultural action. So you got to consider both sides of that. And then you got to consider not only what you do to carbon, but also methane and nitrous oxide. Plus, some of these sequestration activities, like converting land into forests, reduce commodities from the marketplace. So there's a tension with food. Some of the no-till can reduce yields. Also, it's substantially more risky initially. So people need to be compensated to do it. And we need to consider tensions with food production. There are some science developments that might help the situation. We might be able to breed deeper rooted crops to put carbon deeper into the soil. We may be able to do what we call biochar and pyrolysis, where we use some agricultural commodities and convert them into forms of carbon that can be buried in the soil that last a long time, and we can enhance deep soil sequestration. In general, this carbon sequestration, I did a study one time and it showed at different carbon prices how much of it you got. Well, it rose to a particular point and then it fell. The reason that it fell is because competitively biofuels and converting land to forest get higher rates of the sequestration. So the ag soil portion is complementary to what we do at low prices, but at higher prices, they're better substitutes. And then to make this market work, I don't know why this window won't go away. We need incentives for buyers to go and buy. Right now, we don't really have those except in select states like California. If we're going to use a government payment, there wasn't very much funding attached to that Senate Act, and we're really going to need some sort of a budget reconciliation process to put more funding in it. This will cause, if agriculture comes in, it'll lower the costs of purely acting on the emissions side. Agriculture will be invited in if the costs in agriculture are less than the costs in other sectors. And generally they are less for some options. But exactly where we get those emission reductions, again, it's less likely in hotter, drier areas like Texas than it is in more temperate areas like the Midwest. Finally, I think agriculture has to embrace the fact it's not going to get the full carbon price. There's this crazy word called fungible, which really talks about whether one thing can be traded for another. And it's a little bit like a stock prices where one stock is worth more than another because it has higher earnings, and the difference in prices makes the two things so they're exchangeable. Well, I think in agriculture, we have some imperfections in some of the greenhouse gas management things that we can do. And as a consequence, we're going to face a grading standard a little bit like you do when you sell corn and they look at the moisture content and the foreign matter. So you're likely to see a discount come in for some of the agricultural things relative to other things in the marketplace. There are a number of other things we can do in agriculture with manure lagoons and enteric fermentation, biofuels, fertilizer, and fossil fuel usage. We could not only discuss those, but consider some of these others, although they're nowhere near as pervasive as agricultural soil carbon sequestration. We're likely not only to see some sort of a carbon market, but also some kind of a government market. And we may see continuation of programs like EQIP that at the same time as they accomplish some environmental goals, also accomplish some greenhouse gas goals. The final point that I will make is that we've been talking about what we call mitigation in the climate change arena, which I call reducing the drivers of climate change, less greenhouse gases in the atmosphere. But we're also going to see impacts on production systems, and we're going to see the need to adjust those production systems to better operate under the warmer climate. It's pretty inevitable that we're going to face about a 1 degree warmer climate over the next 20 years. So regardless of what happens with agricultural mitigation and energy mitigation, we're going to have to be able to accommodate that. And to me, that's actually the bigger long-term agricultural challenge at the moment than is the mitigation side. So with that, I will stop talking and see if there are any questions. I see one thing in the chat box, but I have no idea what it is.
All right, real quick, I'm going to turn the presentation over to Kirby Smith. He's our market president here for the Gossa location. I'm going to have him talk about the Citizen State Bank just for a little bit. And then we will turn it over to Dr. Anderson to talk about the markets.
Good morning, everyone. And like Tyler said, I just want to thank everybody for joining us here today. The Citizen State Bank and Home State Bank and Terra Financial, we're all part of a group that's very agriculture focused. And we would really like to provide some information to you guys to help you make informed and profitable decisions. We appreciate the opportunity to partner with you on producing food, fiber, and fuel for our world. As we learned from Dr. Briggeman today, got some interest and economic outlook for the future. There's always some uncertainty out there, so we're happy to be your local trusted source for that information. There's also some new and exciting opportunities like Dr. McCarl put out that possibly could help you guys in the future find new revenue streams and find new opportunities for profit on your operations. Our goal was to assist you guys and give you access to information and things like that to make those decisions with.
along those lines, we're going to try to continue to do these Zoom get-togethers occasionally. If you've got any topics that you can think of that you'd like to hear more about, please get with one of our team members at our crop insurance agents, our loan officers, anybody like that, and give them some feedback so they can let us know the things that you guys are interested in. You know, we've got a great team of people here with a lot of different skill sets and a lot of different strengths. So please search one of our guys out. We do a great job. We'll do everything we can to assist you to be profitable in your operation. The other thing I was going to say is if you have any feedback about what's going on out in your community, please feel free to contact one of those guys and visit with them about what's going on in your area. If you know of some sales of real estate or farm sales or anything like that, the more information we can get, the more knowledgeable we are. So we want to be a source of information, and we also want to hear from you guys. So again, I appreciate the opportunity to work with you guys. Please contact us if you need anything. And thanks again, and enjoy the rest of the presentation.
Dr. Kim Anderson is joining us this morning from Oklahoma State University. He's going to be talking about, I know we just finished with wheat harvest, and hopefully everyone has a marketing plan that they followed. If not, Dr. Anderson will hopefully have some information for everyone that they can use in that marketing decision-making process. There is still the poll out there. I'll probably close it here in the next 5 minutes so we can show the results at the end. Dr. Anderson, the floor is yours.
All right. Thank you, Tyler. You asked us to introduce yourself. Well, I'm Kim Anderson, ag economist, Oklahoma State University. I've been in this business for 39 years. I want to visit with you a little bit about selling your wheat, corn, and beans. I'll be talking about, of course, cash wheat prices since the harvest is ongoing and over for some of you. On the soybeans and corn, we'll be talking about the forward contract prices. I want to first cover my philosophy about marketing or selling. Anyone who says they can predict prices accurately enough to beat the market is an exceptional person, or they're lying through their teeth. And what I found most often, they're lying through their teeth. So how do you make a profit from marketing or selling your commodity? Well, it's an efficient market, and the corn, the wheat, the beans, most of our major markets are efficient markets. And an efficient market is a market that incorporates all available information to determine the price. And of course, that goes on at the Chicago Board of Trade with the cattle contracts, the grain contracts, the cotton contracts. Big companies, big players spend millions of dollars obtaining information, and based on that information, they buy or sell, and that makes your price move. So how do you earn a profit from marketing? Well, profits earned by people or companies who acquire the relevant, information before anyone else in the market and analyzes that information better than the other market participants. So what makes today's price different from yesterday's price? Or what will make tomorrow's price different from today's price? It's new information. And if you believe this, then by definition, prices cannot be predicted. So I want you to take that seed and grow it, take that thought and think about it as we go through the rest of this presentation. Some news in the market. Right now, we're looking at world wheat production at 29.2 billion bushels. 28.5 billion bushels was produced last year. Those are both records. Your world wheat ending stocks are projected to be 10.9 billion bushels. 10.8 last year. The record was 11 billion in 19. So we got more than adequate wheat around the world right now. You look at world corn production, 46.8 billion bushel projected, 44.3 last year. So an increase in corn production this year. Corn ending stocks, 11.4, slightly higher than last year, or really this year in corn, what we're talking about. The 20 that ends in August So you got 11 billion last year, so slightly higher in these stocks. The record was in 2016 at 13.9. Soybean production at 14.2 billion bushels, up from 13.4 in 20. Those are both records. World soybean ending stocks at 3.4 billion bushel. It was 3.7 record in 19. It's important that in corn, you realize that the ending stocks are projected to be 1.36 billion bushels next year compared to 1.1 this year. It was 1.9 3 years ago. So corn ending stocks have been going down, slightly higher next year. Soybean stocks, 155 million bushels. That is tied soybean stocks. In the world, China's imports for next year are projected to fall from 26 to 20 million net metric ton. Their wheat imports are projected to increase because of rain. Ukraine is raising 17% more grain. Their corn is going to 37.1 billion from 30.3. Their wheat 28.5 from 25.4. Russia's exports are projected to increase. We have in the Black Sea, Romania, underselling Russia for Egypt wheat exports. Now let's switch to wheat. If you go back to 2008, excuse me just a minute. If you looking at wheat prices, this is the monthly average Kansas wheat price adjusted for 5 cents per month storage. So I took the Kansas monthly average price, and starting in August, I subtracted 5 cents a month. So 5 for August, 10 for Sep, 15 for October, and so on. Over this time period from 08 through 2020, your average price was $5.20. Your current price is $5.46. So my question to you is this $5.20 a relatively high price? Is this a price where you want to sell your wheat? If you look back over time, this $5.20 really from 2008 to the beginning of, and your tick marks down here mark June 1 of each year. So this is the start of the marketing year. So 8 through 9, you had relatively low prices. Prices were up 10 through the 13 marketing year. Then back down for 14, 15, 16, 17, 18, 19, and 20. So a long run of below average prices here. As you look at prices and as you're making your wheat marketing decision, your current price this morning was $5.46, right around $5.50. Is this a relatively good price, and do you want to sell? Now, another way to look at this is your monthly average prices. And again, these prices have, June is the actual price, July is a -5 cents, August a -10 Sep. So if you're looking across here, your June's going to be $5.38. Your July is really $5.40 is the actual price, but we took a nickel off for storage. If you go out to November, it's a -25 cents storage and interest, so it's $5.36. And if you went out to January, it'd be $5.51. So if you've got on-farm storage, you want to add 5 cents a month. So 5, 10, 15, 20, 25, 30, 35 cents as you're going across to bring these prices back to what you would face with on-farm storage rather than commercial storage. Now, my question to you is, as you look at these monthly prices, or as you looked at this chart, and if you cannot predict prices, when do you want to sell your wheat? Well, if you average each month in June, July, and August in Kansas, your price was $5.38, $5.35, and $5.29. That's the average over this 11-year period. As you go out, because of storage, your price declines. So if you're just going to not necessarily beat the market, but beat the average market price, you're going to sell in June, July, and August. Now, another question I ask is, if prices are low, are the odds that they're going to go higher? Or if they're high, are the odds that they're going to go lower? Well, one good way to look at this is your chart here. When prices were low, 14, they were going down. 15, they went on down. 16, they did come up, but they stayed below average. And so I'd say that prices stayed relatively low. And you can look at this. In 15, 538, highest price. 16, 374, highest price. 17, 442 in July. Boy, a good thing we're up in Kansas, so we're selling the harvest after we're getting the combines running. 442 and then down. 18 down, 19 down. In 20, they started coming up as we got out into the September, October, November, December time periods. And this is because your foreign crops, your Black Sea area, your production was slightly less than expected. And demand for US exports were good as they looked at the foreign crops, and that caused your price to go higher out here. So a bottom line on wheat, if I can't predict price, if I'm storing in a commercial storage, I'm going to sell my wheat probably in June, July, and August. Now let's look at corn prices. Again, from 2008 through 2020, your average price over this time period was $4.20. Now I'm again adjusting this price for 5 cents a month for storage and interest. Your current price, this is a forward contract for harvest delivery, is up in your area, is $5.04. That basis is a minus 24 off the D's contract. So if you want to calculate what you can forward contract for corn for harvest delivery, it's a minus 24 off that D's contract. The tick marks, they're September 1 at the beginning of the marketing year, just like wheat was June 1. So you can look across here, relatively low corn prices. Corn and wheat prices tend to go and mimic each other to a certain degree. Low prices, 13 or below average prices. You know, in 13, this price held till we got out into the January time period, then came on down and came across. The question to you is, you've got corn in the field. Do you forward contract some corn for $5.04 when your average price has been $4.20? Now your price has been up here for forward contracting corn up, I think, $6.57 up in this area. It's now back to $5.04. Will it go back there? And remember my philosophy, you can't predict prices well enough to beat the market. Looking at corn, this shows the entire, all 12 months coming across here. Yellow marks when the highest price for the marketing year was. Down here, I don't have prices for June, July, and August for the 220, 221. So I just stuck in 568. I think those are way too high. I made this chart last week, Tuesday. What have we done on corn? We've taken, about 50 cents off the market in 2 or 3 marketing days. So these are probably high here, but I just did them so we'd have these averages down. Now I'm going to narrow this down for September through June so we can see the numbers a little better. And again, we've taken 5 cents a month storage and interest off. So these are the adjusted averages down here on the bottom. So this would really be 424. This would be 422 if you've got on-farm storage. But what corn shows me now, remember on wheat, the harvest months, June, July, and August was the best time to sell wheat. Corn, if you average and just do a mechanical strategy, looks to me like you're going to sell corn in February, March, April, and May. Now, if you go back out to all years on corn, you can see that it goes down in June, July, and August. So that's why I cut it off in June here. Now, the other question is, and you can see it with the chart, if prices are below average, or the odds are that they're going to go above average. And you can look at this chart and see that that's not necessarily the case. And you can look at this. You can go down here again, starting in 13, 513 is the high, goes down 14. Dees did get to 375. October, November was higher than September. The October and November prices tend to be higher than September prices if you look at the averages on the bottom. But you can go down to here and every year except 2020. And again, if you had held that for this February through May time period, you'd have captured these higher prices here. You may not have waited for that 568. We got that good May. We'll see what June ends up being, but it's definitely going to be lower than that 568. So if you're doing a mechanical strategy with corn, or if I'm thinking about on-farm storage, and so if I've got on-farm storage, then I'm adding 5, 10, 15, 20, 25 cents to this. So you're looking at 448, 30 cents to this, 453, and so on. Still, I'm marketing out in this period, but if I've got on-farm storage, it has a higher probability of paying me to do that, maybe to build that storage. But that's another analysis. So with the corn strategy, and if I'm going to do a mechanical strategy, I'm probably going to store some corn. If I need cash, on the average, what am I running here? 419. So we're only talking 4 cents here versus October. So I may not want to manage that in commercial storage, or I may need the cash. So I sell in the November time period rather than this time period out here. Looking at soybeans, your average price over this period has been $10.40. You can currently forward contract for $12.44. That's I think a minus 74 basis. I've got that written down here somewhere. There we go. Yeah, that's a minus 74 basis for off the December contract or the November contract for soybeans. You can forward contract for $12.44. When your average has been $10.40, is that still a good price, even though you've had the opportunity in the past month or so to forward contract up around $14? Now, this is your monthly average price for May. Now, this is the monthly average price in Kansas minus storage and interest. And the tick marks mark the beginning of the marketing year or September of each year. Looking at the soybean monthly average prices. Now, soybeans September is higher than October, November, December, and January. Notice soybean prices tend to get higher out here in this May, your February, March, April. Oops, don't want to click the clicker. And May time period, 1076 is our high price out there. You'll notice that soybean prices are scattered around the year, but mostly at the year end. Another thing with our average price being 1040, most years out here, you get closer to that 1040 as you come out to the end of the year. So beans also with wheat and corn, this 13, 14, 15, 16 time period, 12 soybean prices held their price higher longer than wheat and corn. Now, it's 15, 16, 17, 18, and 19, and going into 20, we were below average at harvest and during those times, relatively low prices in all our grains. So if I'm raising soybeans and I'm doing a mechanical strategy because I can't predict price, I'm probably going to store. I mean, when you're looking at 992 average price, 1002, 1011 during the harvest time period versus average prices out here, 1063, 1076. And remember, these have got 5 cents a month storage and interest taken off of it. So if you're in a commercial elevator, these are your net prices coming out here. So it looks to me year in, year out. Now, not every year. You go back in 12, well, 425, it paid a little bit to take it out there, 1235 to 1410. There are some years that it will pay you to sell earlier, but on the whole, out in the March, February through June, through July time periods is the time to sell your soybeans. Now, if you want to look at some price comparisons on wheat, again, we're deciding what does your current wheat price is $5.46. That's 34 off the September contract in your area. Is that a good price? Well, your average for all prices, now this is just not the harvest period, this is the average for your all prices adjusted for 5 cents a month storage is $5.35. So you're looking at selling at an average price. Your highest price over the 2009 through May of 2021 has been $8.27 and your lowest price $2.96. Is this a price you want to take? Now you can go back to those tables and see that is still slightly above your average. So, and you can go back to the news. You can go back and look at what is the world situation. Well, you're looking at record world production. You're looking at slightly higher world ending wheat stocks. You're looking at Romania out undercutting Russia in the Black Sea area for Egyptian soybean sales. You've got significantly higher expected exports out of the Black Sea this year than last year. Is $5.46 a good price? If you look at forward contracting corn for $5.04, your average corn price in Kansas is $4.20. Your highest is $7.08 and your lowest is $2.99. Soybeans, you can forward contract for $12.44. That should be a minus 74 here. I made this morning, and anyway, your average is $9.55, so you're well above your average Kansas price. Your highest price is $14.25, and your lowest price is $7.68. Are these prices relatively high prices? If you look back over the last 5 or 6 years, yes, for wheat they are, because you averaged around 440 rather than 546. If you look at the full time period, 9 through 21, it's not a high price, but it's a relatively good price. You may want to take some of it and hold some of it. Alternatives, you can sell your wheat and buy a put, or you can buy calls rather than forward contracting your corn and beans. This morning, you could sell wheat for $5.46. You could buy a $5.90 December call for 48 cents. You could buy a March call for 55. And if I'm going to lay out 48 cents, I'm probably going to lay out another 7 so I can get a few more months out of that contract. But that'll give you a minimum price of $4.99, which is below your average price. If you're looking at buying a 530 corn put, that's an at the money put for your these corn, it's going to cost you 50 cents. So that's going to, using the basis, your forward contract basis, that's going to give you a minimum price expected of $4.56. If you look at soybeans, you can buy an at the money 1320 soybean put for 90 cents. Using that 78 under basis, that's going to give you $11.52. So what's my philosophy? Take the emotion out of the sell and buy decision. You don't want, fear, greed, whatever. You don't want to sell based on those. So you want, in my opinion, you want to have a mechanical marketing strategy. You want a written plan. If you're like me, I can have a plan, but I can modify that plan in my mind real quick or get it mixed up or whatever. You want a written marketing plan. You want to have the discipline to follow that plan. And I like to keep a few bushels. If I've got thousands of bushels of production, I'm probably going to keep 1,000 or so. If I'm a smaller producer, I'm just going to keep a couple hundred. It's not going to cost me a whole lot. It's not a lot of risk, but if prices do take off like a scalded dog, then you can sell some product, corn, wheat, beans, or whatever, and say, hey, I sold some wheat today for $7. You don't have to tell them it's 50 bushels. You want to concentrate on producing a quality product that the market wants. And if you do that, price will take care of itself. It will not always be a price you like, but over time, if you're efficient, if you manage costs, if you produce a quality product, you have above average yields, over time, the market's going to give you a positive return for producing that commodity. Rarely will you sell at the top or bottom of the market. So you want to use the market because you're not going to beat it. And you use it by having a written marketing plan. You use it by knowing your cost of production. You use it by knowing how much money you've got to have to survive and to make a living and to buy the goods and services that you want and need. You don't market commodities. You don't market corn, soybeans, or wheat. You sell your corn, soybeans, and wheat. You market land, labor, capital, and management. Think about it. What can you control? You can't. Now you can have an impact on yield, but you can't control yield. Weather does that. You can't even have an impact on prices. You can select prices, but you cannot change prices. Use the market. Don't try to beat it. Use the market. You sell commodities. You market land, labor, capital, and management. That's what's under your control. And produce a quality product that someone wants to buy, and price will take care of itself. I'm doing relatively good. I've got to go make my weekly TV tape here in a few minutes. I've got time for a question or two or a comment. Guidelines. And I think this is one of the best things that I've learned. Make decisions that will let you sleep. If you wake up at night worried about having to sell at lower prices, sell some wheat. If you wake up at night worried about not having the opportunity to sell at a higher price, store the product or store the wheat. Think about it. And doing that and following your plan will normally help you increase the price you receive, and it will make you a better farmer and producer. Last thing. Oh my goodness. There we go. Peter Drucker said, there are no solutions with respect to the future. There are only choices between courses of action, each imperfect, each risky, each uncertain, and each requiring different efforts and involving different costs. But nothing can help you more than to realize what alternatives are available and what they imply. And with that, Tyler, I thank you very much for allowing me to visit with your producers.
Thank you, Dr. Anderson. And thank you to all of our presenters today. I thought all of them did an excellent job.
Tyler, one last thing, I'll send you a new set of PowerPoints. I changed some while the others were talking.
Okay, all right.
All right, thanks again.
Yep. Thank you all for joining us today. We hope you found the presentations informational and enjoyable. Like Dr. Anderson said, he'll have a new set of PowerPoints to send out. I think Dr. Briggeman mentioned he would get us a set of PowerPoints to send out. And we will also send out the polling results with those to our folks who signed up to watch, and for those who said that they would sign up to view the recording. We'd like to mention that acreage reports for spring crops are due by July 15. And if you have some free time, you can see Terra Financial Inc. Crop Insurance and the Citizen State Bank at Farmer U and Trade Show on August 18th and 19th in Mulvane, Kansas. Thank you all again, and we look forward to seeing you all soon.